Starbucks stock is up big after it hired a new CEO. Does this mean Starbucks is a good stock to buy now? Welcome to Global Value. Today, we're performing a fundamental analysis of Starbucks using Warren Buffett's investing framework. We'll look at 6 key financial metrics before we figure out 3 different fair values to understand what Starbucks is worth in today's stock market. Plus, I'll share 2 special bonuses that could be the deciding safety factors when adding Starbucks stock to your portfolio. Right now, Starbucks trades for $94.20 per share. In its last day of trading, it's up 0.31%. Since August of 2023, Starbucks stock is down 5.5%. This lags the market where the S&P 500 is up over 20% at this time. However, Starbucks stock is up 20% since they announced the hiring of Brian Niccol, the former CEO of Chipotle. He's scoring a massive $113 million payday, which includes a $10 million cash payment. In the last 5 years, Starbucks has trailed the market, declining by 12%. In the last decade, things are a lot better, with the company compounding at 7.9% annually. They were beating or keeping pace with the market for much of this time coming into 2024. Even as the companies off their all-time highs hit back in September of 2021, in the last 20 years, Starbucks has compounded at 9.7%, and they beat the market pretty handedly since 2012. Even better for Starbucks shareholders, right now they pay a market-beating 2.39% dividend yield. These are added to the gains in their stock, and Starbucks has easily beat the market. Today, Starbucks trades $13 below its 52-week high. This comes as the company trades $23 above its 52-week low. And how big is Starbucks? As the United States' leading coffee chain, they have a $106 billion market cap. Getting started with our first metric, we want Starbucks' average return on capital to be greater than 14%. Think of this like your form when you're in the gym lifting weights. You want great form just like a company wants to deliver great returns on its capital. Starbucks had been doing some financial engineering, which is why their return on capital numbers were so high in 2019. Then the pandemic hit, and in 2023, these fell like a rock. Still, since then, the company has steadily and stably rebounded, increasing their returns on capital since then. Today, this sits around 33%, and in an average year over this time, Starbucks earns 35% returns on capital. That's 5 times better than a normal business, and this is a huge check on our first metric. Starbucks earns great returns. So what does Starbucks really do? Starbucks is one of the most widely recognized restaurant brands in the world. It operated more than 38,000 stores across more than 80 countries as of the beginning of 2024. The firm operates in 3 segments: North America, international markets, and channel development. These include grocery and ready-to-drink beverages. The coffee chain earns money from company-operated stores, royalties, sales of equipment and products to licensed partners, ready-to-drink beverages, packaged coffee sales, and single-serve products. Starbucks was founded in Seattle in 1971, and its growth was led by its famous CEO, Howard Schultz. Next, we want growth in their sales, earnings, and free cash flows. These would support their high returns on capital. From 2019 until today, Starbucks has grown their sales by 38%. Again, almost everything dropped for the business amid 2020 shutdowns, but things have rebounded very well. With sales growth also has come earnings growth. Starbucks has grown their earnings by 15% over this time, and their free cash flows have increased by 22%. It's great to see all 3 of these are up, which is what we're looking for, and it's another check on metric number 2. Keep in mind though, Starbucks margins have come down over this time, and the company is starting to lose market share to smaller coffee chain competitors. That's a major reason for their recent CEO switch. Now, who owns Starbucks? With the latest round of 13F filings, today there are 7 super investors who own the stock. This is led by Chris Bloomstrand, who has a 3.2% position in Starbucks. Also on this list is Tom Gaynor from Markel Group. Next, in our third metric, we want EPS growth. This helps us look at Starbucks like an individual shareholder. We learned in this time Starbucks has grown their earnings by 15%, and at the same time, they bought back 7% of their shares outstanding. This leads to even stronger earnings per share growth, and the company earned $3.58 in 2023. That's increased a little bit in their last 12 months, and it's another check on metric number 3. Starbucks is perfect in our first half. Metric 4 is similar but even more important. We want free cash flow per share growth. Free cash flows are the lifeblood of any business, and it's great this is almost the same story. Their cash flows per share are up over this time, and it's another check on metric number 4. Now, why don't we look at Starbucks' dividend? Right now, Starbucks pays a big market-beating 2.39% dividend yield. They've even grown this for 14 years straight. But is this dividend safe, and can it keep growing? We can try to answer that by looking at whether it's covered by their cash flows or not. In 4 of these 5 years, Starbucks was able to comfortably support their dividends using their cash flows. The company paid and kept increasing their dividend in 2020, even despite not being covered by their cash flows. While that worked out in hindsight, it may not have been the best decision at the time. That wasn't the most rational decision for capital allocation, but their dividends are covered today pretty easily by their cash flows. That's what we wanted, and it's the case in the last 3 years. This is another check on our first bonus. Next, let's look at their balance sheet. Great companies can grow, earn high returns, and don't need a lot of debt. Starbucks until recently fit that description. Things changed for the business in 2019 into 2020. That's when the company took on a lot more debt. At the same time, their free cash flows came down quite dramatically in that year. Still, thankfully, these were positive, but now they have to pay down some of that debt, and they've been paying an ever-growing dividend. Starbucks' leases are also added back into this number, which may unfairly penalize a restaurant business. Still, in 2023, the company had around $20.5 billion of net debt, and in their last 12 months, this has climbed to $22 billion today. In the last 5 years, Starbucks has only brought in $14.1 billion of free cash flow, which isn't quite enough to support this. Their average cash flows don't support this either, which unfortunately means it's our first X of the day on metric number 5. Now, before we get into our valuations, it's time for our safety bonus. Warren Buffett's teacher and the father of value investing, Ben Graham, wanted to see a current ratio bigger than 1.5 times. This was his guideline when picking individual stocks. Unfortunately for Starbucks, they haven't been at this mark in any of the past 5 years. Still, things might be different for the company. Starbucks doesn't have the same working capital requirements as other companies. This is why they're able to earn such high returns. This is especially the case in their franchise stores. Because of this, while this is off and it's an X on our safety metric, it may not be something to be totally worried about. Still, it is something to keep in mind, and you'd want to dig into the company's filings and research the business to learn more. Now, how much is Starbucks worth? The big metric of them all, metric number 6, is also our first valuation. In it, we want Starbucks' average cash flows divided by their enterprise value to give us a yield bigger than 5%. This would match the historical yield from the S&P 500 and be above the 10-year treasury. Today, Starbucks has a $128 billion enterprise value. This is the sum of their market cap and their net debt position, and it helps us look at the company like a private business. In an average year over this time, Starbucks has only brought in $2.8 billion of free cash flow. When we divide that by their enterprise value, it only gives us a 2.2% average free cash flow yield. In their last 3 years, they have a 2.7% average yield, and in their last 12 months, they brought in nearly $4 billion of free cash flow and have a 3.1% yield. All 3 of these are below the 10-year treasury and the benchmark we wanted. This means for Starbucks on metric number 6, it's an X. But don't throw out the business. Let's look at our next 2 valuations. Next, we'll use a DCF model to credit Starbucks for its growth. Here, let's take their cash flows and use historical assumptions to grow them into the future. Remember to do your own homework. Let's assume they grow their cash flows by 12.5% in each of the next 10 years. Then in the following decade, we'll assume this growth slows down and the company grows at just under 9% annually. That would be even a faster growth rate than we've seen in the last decade for the company, so it's assuming that they turn around their operations. If we wanted a market-beating 15% rate of return, which is the same return Warren Buffett looks for in his investments, then today it looks like a fair value based on these assumptions and their current valuation says Starbucks is worth around $50 per share. They've been semi-predictable over this time, but that's still well down from their current stock price. While Starbucks has only kept pace with the S&P 500 in the last decade, today they do trade below their 10-year median PE and their 10-year median price-to-sales ratios. Still, this is much higher than an average stock throughout history. Starbucks has been one of the great long-term compounders of the past 30 years. Howard Schultz came back as the company's CEO during the global financial crisis and really righted the ship. Since then, Starbucks stock is up more than 24 times, and they've been one of the top-performing companies in the past 2 decades. High valuations with lower expectations for growth is why our third valuation comes in at $104 per share. That's down $10 from their current stock price. Now, Warren Buffett likes the numbers, but it's the qualities of a company that are his true love. Why don't we learn what these are for Starbucks through a long and a short thesis? We'll start with the long thesis first. Number 1, Starbucks Connect initiative should drive continued adoption of the firm's loyalty program. This would materially increase customer lifetime value and help drive new user acquisition. Number 2, ongoing attention to new beverage platforms and menu architecture designed to target specific customer groups should give data-driven Starbucks a durable edge over smaller competitors. And number 3, the firm's reinvention plan with investments in partner wages, cold brew bar technology, and on-demand brewers should unlock peak transaction volume capacity. But their rethink in operations isn't all positives. There are some negatives hurting the business as well. Number 1, declining traffic with the firm's occasional customer base may take multiple quarters to reverse. This pressures comparable same-store sales and margin expansion initiatives. Number 2, future cash-on-cash returns in China are expected to be substantially worse. This is in stark contrast to the 50 to 70% returns that Starbucks has historically enjoyed as competition in that country intensifies. And number 3, shrinking growing regions could drive structurally higher green coffee prices. This would threaten gross margins if not passed along by Starbucks. It also could drive consumer switching toward cheaper caffeinated alternatives. It's interesting Starbucks made a big change when their previous CEO had just been in the role for under a year. Brian Niccol does come in as CEO after 2 major activist investors, Elliott Management and Starboard Value, came on board with major positions in the company. Now let's put everything together for Starbucks. In our fundamental review, we learned the company goes 4 for 6 on the Select 6 analysis. They earn high returns and they have grown, rebounding from the pandemic. However, the company's margins are down and they added on a lot of debt in 2020. Still, they've been returning a ton of capital to shareholders, but the company needs to get back to operational excellence for this to truly be worth it. At the same time they're revamping operations, the company is dealing with some substantial headwinds and increased competitions in key growth areas like China. Remember, this isn't financial advice. When we put together the company's qualities and their numbers, today, despite the CEO change, it only looks like a fair value for Starbucks comes in around $60.50 per share. That's down more than $30 from their current stock price, and Starbucks looks overvalued. To find stocks that are undervalued, sign up for our investing tools where you can make exclusive requests and track more than 110 stocks and counting.